So Kevin, what I want to talk about is the concept of getting not only proper investment diversification, but proper tax diversification. And to understand this concept, you've also got to understand how different investments are taxed. And there's typically three different ways that your money is going to be taxed. Are you familiar with those, Kevin?
Not very well.
Okay, so let's kind of talk about these in terms of different pools of money and buckets. First of all, you've got investments or accounts that you put money into on an after-tax basis. And when you pull it out, a portion of it is going to be taxable. So some of the gains, capital gains, or interest or dividends. Can you think of different types of accounts that might fall into this category?
Is it like my checking?
It would be your checking account, sure, if it's producing interest. You got it. What else?
Well, I've got a brokerage account. That's got capital gains on it.
You got it. And in that brokerage account, you may have stocks, you may have bonds, you may have mutual funds, you may also have CDs, you may have money market accounts. So these are all examples, and they're pretty common, and that tends to be where people, as you know, may accumulate money, especially early in their life, checking accounts, savings accounts, things like that.
Yeah.
There's another type of account, or another pool, and that is where you're putting money in on a pre-tax basis, and when you pull it out, it is 100% taxable. Can you think of anything that falls in that category?
Is that my 401k?
Yeah, exactly. That's a great example. 401k plan. Okay, any other kinds that come to mind?
Well, I've got a pension.
Okay, pension plan or deferred comp plan. There's IRAs. There's other types of company plans, even 403B plans that are similar. So any type of employer-sponsored retirement plan where you're putting money in from your paycheck on a pre-tax basis. That's a very common retirement savings vehicle, and then it's kind of a ticking tax time bomb, because ultimately when you pull it out, it's going to be 100% taxable. Okay.
Mm-hmm.
There's also another pool, and that is where you put money in on an after-tax basis, but when you pull it out, it's entirely tax-free. Can you think of anything that falls into that category?
I think I've got a Roth.
You got it. Roth is a good example. Now that could be a Roth IRA, it could be a Roth 401k. Now there's limits on that based on your income and also how much you can put into it, but it can be a good example of what falls in that category. Anything else come to mind?
I think we've got 529 for our kids.
529 is another good example.
Yeah.
That can be a really good college savings vehicle, and again, there's some limits on that because it's not something you use for retirement or buying a house. It's limited specifically for college, but it certainly can be good. There's other types of investments as well. For example, there's cash value insurance. And this can be something that's probably the most flexible of all these because you can use it really for anything you want. A lot of business owners or individuals in high tax brackets or high net worth individuals will use it because it can be a great tax shelter. Again, you've got to qualify for it, so there are some limitations as well. And what else? Anything else come to mind?
I'm not sure.
Could be other things like municipal bonds, even some types of REITs. So there's all types of different options within this category. Now if you think about just the general public as a whole, and you think about these three different pools of how you can save your money, where do you think the typical American tends to put more of their money? Where do they tend to be overbalanced?
Probably bottom left.
You got it. Most people are overweighted down here because it's the place where people tend to accumulate a lot for retirement. They've got the 401k plans. Where do you think most people are underweight of it?
I mean, I don't have much in the bottom right, so I would assume there.
You got it. You're very similar to most Americans today. They tend not to focus on this, which ultimately, and just your situation is a great example, you've got about 80% of your money here and about 20% here. And by shifting assets and maybe building this up a little bit, it can really significantly add to your ability to achieve financial independence. And let me give you a great example. Let's say, for example, you wanted to pull out $100,000. You wanted to net in your hands $100,000. What would you have to take out of this pool, do you think, to net yourself, factoring in taxes, to net yourself $100,000?
My guess is about 150.
Yeah, you're pretty close. So about 150. So figure about 50,000 would go to taxes. Give or take. Based on your tax bracket and whatnot. How about this pool up here? Some of this money is going to be taxed because it's going to be capital gains. What do you think you'd have to rough figure? What do you think you'd have to pull out to net 100,000?
What is that, about 120, 125?
Yeah, I would say that's pretty close. So right around and again, depending on your tax bracket, you'd probably have to pull out about 125 to net that. And then here, what do you think you'd have to pull out?
Doesn't seem like I'd have to pull out anything.
You got it, zero taxes.
Just,
So
yeah,
you
just
pull out 100.
just 100,000.
You got it. Nothing goes to the IRS. It all goes to you. 100,000 in your hand.
Yeah.
Okay. So based on that, can you see the sense in making sure that you've really got a little bit more balance than you have right now, and maybe focus on building up some of the pools that are a little bit deficient for you?
Yeah, give a little bit less to Uncle Sam.
You got it. Any more in your pocket, it's a good thing. So over the course of now in our next meeting, I'm going to come up with some ideas and strategies and really look at this for you to figure out what do we need to do to put yourself in the most favorable position down the road so that, again, you're keeping more of your money instead of giving that to the IRS. That sound good?
Sounds great.
All right, great.